Ne- Next up, we're going to get Chris Gernard up. As Chris comes up, I'll introduce him a little bit. Chris has been in our market a long time. Very experienced investor, done a lot of things. Rehabs, rentals, new builds, storage. He spoke about when he came and spoke and did his speech at our meetup. He really spoke about being opportunistic and seeing what the opportunities are at any one time. So I'm definitely interested to pick his brain. So thanks for coming, Chris.
Absolutely. Happy
So
to be here.
awesome, man. We really appreciate it. So tell me, what are your lessons from 23? How did you find this year?
I wish I would have sold a lot more last year. So when I first started in New Orleans, it was during the last downturn back in 2008, 2009, 2010. So what has happened between 2010 and now? It's pretty much been all growing, right? And I've acquired a lot of assets here in this market. And so real estate's peaks and valleys, right? You're not gonna ride the gravy train forever, right? And it's how you manage your inventory in up and down markets, right? I would love to be focusing all my time right now on purely acquiring property because I think, as you mentioned, absolutely, when time gets tough, those create very good buying opportunities. But also, it's how do you manage the inventory that you have now due to all the things that are happening in the market. With the last guy that was up here, insurance is a real killer. I mean, it is a very big issue here in this market, especially if you're a holder of rentals and you're a cash flow investor. For the first time, I actually had my insurance agent, which is Arthur Gallagher, they're nationwide. I had him pull a list and give me the markets that have the cheapest insurance rates. And I'm sitting there going, wow, my investment criteria has happened to go down to where insurance rates are low, right? Because your biggest expenses is your taxes and your insurance, right? Those are your two biggest expenses. Those make the biggest impact on your bottom line. And so when I say what my biggest probably regret is, I sold a lot of property in 22. I just wish I would have sold a lot more, right? Because people were buying. So now there's a lot of properties that I'm trying to sell now that they're not moving, right? So I'm actually selling one at the end of this month that I pivoted and I'm selling on bond for deed, right? So you have two choices if you have a property you're trying to sell, right? You can hold your price or drop your price. You can sell on price or you can sell on terms. So I'd rather sell on terms and hold my price. I'm just waiting to get my payout, right? Or you can drop your price and you may take a loss or whatever that may be. And the first guest, he says, all right, what was
Dominique.
Dominique, she says she plays in the 200 and below. Well, in the 200 below, you have a lot of exit strategies in the 200 and below. If it doesn't sell, you can rent it. If it doesn't sell, you can sell it on a bond for deed. So, but when you play in the higher price points, you don't really have a lot of options other than just drop price, right? So that's why that first-time home buyer is always probably the safest arena to play in. I like that strategy. And I had a lot of B&Bs because I got caught up in that craze like a lot of people did, where I built a lot of them brand new. And I don't know if some of y'all were here for my first talk. One of my biggest criteria is replacement cost. Am I acquiring an asset for cheaper than what I can build it new, right? I built a lot of new construction rentals in 15 and 16 that I regret, right? Because I'm building it at today's cost, right? And especially now with the labor cost where they're at, I don't see how anybody can do it. I really don't. So I'm pivoting to a strategy of I'm not dropping my price. I'm going to sell on terms. So when you sell on terms, you could, say your interest rate that you have on a property is say 5%, right? Well, the going rate right now is 9%. So if I sell on terms, I'm going to sell at 9% and I'm just going to make a spread and just hold on the property. And I'll give someone 1 to 2 years to buy me out, right? I'll give them a 2-year balloon, 1 or 2 year balloon. So I'm just basically waiting to get my back end profit instead of dropping my price. So that's kind of the strategy I'm pivoting to now. Also, not investing in New Orleans anymore. I'm really kind of very bearish on New Orleans. I don't like what's going on. It's influx. They can't figure out, the municipalities can't figure out what they're doing.
You talking Orleans Parish, or you talking Greater New Orleans Parish? Yep.
I do have a bigger size development on Jefferson Highway right now that I'm excited about, and dealing with Jefferson Parish is night and day.
Yeah.
Different than Orleans Parish right now. So
I've heard that a lot.
So also, moving forward, I'm making a big pivot to where, I had a lot of rentals here, so I did a lot of in-house property management. I had staff. I'm getting away from that more. I'm kind of pivoting my business more to asset management, because what I do is I raise money to come in the deals, and then, so instead of taking, a 10% management fee, I'll charge an asset management fee of 1% to 2% for managing the investment, basically managing the entity for the investors that are in the project, which is a lot better than managing property. Because if you're managing property, you manage employees, right? And we all know the headache sometimes of employees. They're hard to find. Hard to find good ones, that is. So typical growing pains. Storage is still one of my favorite asset classes. Now it is taking a dip, just like multifamily is, because you have a pause in the market. I mean, you have a pause in home buying, right? People aren't moving around as much as they were over the last year. So my facilities, we're giving bigger discounts. We're dropping rates to get them in. The issue is, it's all about churn of your tenants, right? So if we're dropping rates to keep occupancy, you may have somebody that was paying $1.50 a square foot, or $150 for a 10 by 10. They're moving out at $150, but my rate went down to $1.20 a square foot, so I'm replacing them with a $120 tenant versus $150, right? So that's happening right now. But the good thing is I bought these properties good enough to where we're good, but a lot of people can't say the same about it, because I go back to, you see a lot of new storage, new facilities going up, ground up construction, right? To build these big facilities, you're spending $10 million, or close to, $70 a square foot. If you build, 100,000 square foot facility, that's $7 million, right? So that's why I love the conversions, because our price point that we can get in is maybe half of a new facility. I'm getting the same amount of square footage. That's why I like the conversions. I'm going to stick to that criteria. Really, with the amount of labor costs and where they've been, I'm just not big on new construction right now.
Where else are you seeing opportunity? Because I know you're opportunistic. You tend to, you've done a lot of things, and you tend to flow with the market.
Yeah.
Where do you see the opportunities in 24? Maybe.
So, I play a lot in the tax lien space. I love tax liens with paper. So I play more in the secondary tax lien space, where these institutional buyers basically create these debt funds. They go to the auction, or they go to the municipality, they buy tapes of liens, right? And they do it for arbitrage. Their cost of their money may be 6%. They're getting 12 to 18% on the paper, and they're making a spread. But what happens when these homeowners don't pay their taxes? They got to foreclose on the asset. So what happens is that buyer, that institutional buyer, mandate of his fund doesn't allow him to manage and own real estate, right? They're just paper investors, just debt investors. So I'm buying it from them at really cheap, at a little bit of a premium. So that's been a target of mine lately, where I just bought 66 homes in Rochester, New York, of all places. But I bought them at about $12,500 a house.
That sounds below replacement value.
Right. Well, you can't build a house, right? You barely can pour a foundation for that, right? And of course, not including the land. So that's something. I created a fund. So I'm raising money into that fund, and we're going to improve that portfolio and have the ability of the same seller to acquire more. Like I can acquire 16 more that I'm in due diligence right now, looking at those. I'm paying those $15,000 a house. So some of the houses need $10,000, some of them need $50,000. But if you look at across a portfolio, you're in it for about $50,000 a house, $50 to $60,000 a house, and they rent for $1,300 a month. It's good math, right? But again, those opportunities may not be available in your market. So I've got very good at saying, I want to go where there's opportunity and not just say, I'm just going to invest here, right? So there are opportunities everywhere if you know where to look, and not be afraid to invest out of your market. That would be my biggest advice.
Awesome. Okay. That's really great. I really appreciate you sharing that with us. Thanks so much. You can come for drinks afterwards?
Yeah, maybe so.
Okay. We might better pick his brain a little bit more. Really appreciate it. Thanks, Chris.